Has the market left you just shaking your head the last few weeks? Now, we haven't seen much volatility the last few years as central banks have been on an orchestrated mission to prop up global markets at all costs. As a result, we've been in a one-way, low-volume grind to the upside for years. Now, the market changed a few weeks back when we finally saw sellers wake up from hibernation. Since that time, we've seen some pretty historic moves back and forth with expanding ranges intraday. Now, this can lead to very frustrating trading conditions if you aren't able to track the markets all day long. If you blink in this market, you're potentially missing out on hundreds of points. While this is a great environment for day traders, what does this mean for swing traders who like to be in positions for days or weeks? So let's walk through some of the things that Mike here at NetPicks has been doing lately to really grind out some of his profits. Now, most traders are programmed early on that the only way to make money is to pick market direction and then hope for the best. In the options trading world, this means many are buying long calls and long puts or vertical spreads. But what's the problem with that? Well, with this approach is that you not only need to be right on the market direction, but you also need to be right on the amount of time that move's going to take. When you buy option premium, time is working against you. In periods of high volatility, we actually like to take the other side. We like to put time decay in our favor by selling options. Now, one of the trades that was put on back in August was on Apple. Apple is one of the most popular stocks out there for many traders, and as a result, it's very liquid. Now, instead of buying long calls or long puts to play market direction, Mike decided to put on an options trade that would profit if Apple stayed inside of a price range or a profit window, as we call it here at NetPicks. An Apple position was opened up by selling an iron condor in the weekly options. Now, this name sounds confusing. It's actually a very simple position to put on. An iron condor is put on by selling an out-of-the-money call spread and out-of-the-money put spread at the same time. So here's the trade details. At the time of this trade, there really wasn't a strong directional opinion on Apple. We knew they had a new product release coming up in September, which can cause some choppiness. So we decided to open the trade out in the weekly options with 29 days left to expiration. We sold the 120, 121 call spread and at the same time sold the 111, 110 put spread. Now on the call side, this meant we were selling the 120 call at the same time we bought the 121 call to make it a hedge position. On the put side, sold the 111 put and bought the 110 put to make it a hedge position. Altogether, we sold the positions for 58 cents. This meant we collected $58 per spread to put this trade on. Now, the goal of this trade is to close it out by buying it back for a cheaper price. The profit window is the area that we want Apple to stay inside, and this is defined by our short strikes, plus the amount of premium collected for placing the trades factored in. So in our trade, we sold the 120 call and the 111 put. We collected 58 cents to put the trade on, so we are going to add that to the 120 call strike price to give us a break-even point on the upside of 120.58. We sold the 111 strike put option, so we're going to subtract 58 from that price to get our break-even point of 110.42 on the downside. The profit window that we want Apple to stay inside is 120.58 and 110.42. Now, instead of picking whether the Apple is going to go higher or lower, we are now giving ourselves a chance to make money if Apple goes higher, lower, or sideways as long as it stays inside of the profit window. So the goal of this trade is to close it out by buying it back cheaper down the road. Now, we know options lose value over time the longer they're held, so we can profit on this trade from time decay adding up. And also, we know options get cheaper when the volatility decreases. Now, at the time of this trade, we felt volatility was high, so we were betting on the options getting cheaper by volatility decreasing. And as mentioned above, we also had a chance to make money in all three potential market moves. So why wouldn't we put this trade on every time? It seems too good to be true, right? Well, when you put on an iron condor, the most that you can make on a trade is whatever you collect for selling the trade. In the case of our Apple trade, this was $58 per spread. The most we can lose on this trade is $42 per spread, calculated by taking the difference between the strike minus the credit received for placing the trade. So we have just over a 1-to-1 reward to risk ratio. Now, while this may not seem great to some people, the trade-off is that we have so many ways of being profitable in this position as outlined. The danger on this trade is when Apple pops outside of our profit window. When this happens, we're going to start to lose money. Now, important, This is a fully hedged position. So even if Apple pops outside of our profit window, we can't ever lose more than the $42 maximum loss. So how'd this trade play out? Now, while we put the trade on expecting Apple to stay inside of the tight range, the exact opposite happened. The bottom decided to fall out of the market, and we saw Apple making a big move lower. Now, for a stretch of days, we actually fell outside of our profit window. The nice part about selling an iron condor is that we're putting time decay in our favor. We don't have to feel rushed to get out of the trade. So when we popped outside of the profit window, students were told that the trade was going to be held, expecting it to bounce higher. Well, what do you know? This is what happened. Apple bounced back higher, right back into our profit window. So as a result of being patient, we went from a losing position right back into a profitable trade. Ended up closing out the trade by buying the trade back for 31 cents, giving us a profit of 27 cents or $27 per spread. Doesn't seem that impressive at first glance though, right? Well, remember, we were completely wrong on the market direction and still made money. We actually made close to 50% on the trade, to be exact, in less than 20 days holding the trade. We survived the crazy market volatility and still made money when the market did exact opposite of what we wanted it to do. Now, these are the types of trades that can be so powerful for options traders because you're not focused to wait for one type of market to make money. There are strategies that can be profitable regardless of what the market does. You can't say that about any other market out there. So take the time to expand your options playbook so next time the market throws a curveball, you can go back to the playbook and know exactly what to do. Don't get caught on the sidelines waiting for the next trend move. Iron condors can produce profits in periods of chop and uncertainty. Now, this will make a key trade type as we head into the late 2015s and as we get back into two-way market instead of the one-way grind higher that we've seen in the last few years.